Good afternoon, and in some cases, good morning. We'll just leave it another 30 seconds to allow people to join before we start. Okay, so hello and welcome to our webinar, Asset Retirement Obligations, What Lies Beneath, where we will explore the impacts of oil and gas ARO disclosures and what that means for investment decisions. You can access the report via the QR code shown. I'm Simon Perham. I'm part of the engagement team here at Carbon Tracker. Now, Carbon Tracker is an independent, not-for-profit think tank looking to accelerate the energy transition through the influence of the capital markets. Our research is split across three core areas: energy supply, energy demand, and energy transition, with a number of cross-cutting initiatives. It's all available free from our website and the usual investor-focused third-party aggregators. Today's session will run for up to 50 minutes, and we'll begin with a short presentation from Tino Ganosse, followed by a panel discussion moderated by Barbara Davidson, before we open the floor to your questions. To submit a question, please use the Q&A function and include your name so our team can follow up if needed after the webinar if we don't get time to answer your question live. The Capital Transparency team's work is arranged over several core basic themes and is transmitted through several key products, some of which you can see on the slide. Joining Tino and Barbara today are Philip Dawes, Head of Distribution UK and Ireland at BNP Paribas Asset Management, and Rob Shuak, Director of Research at the Polluter Pays project. And some of you will recognise Rob. He is a much cherished ex-colleague of all of us at Carbon Tracker. Tino, over to you.
Thank you, Simon. Hi, everyone. Thank you for joining this afternoon's webinar. Today, I'll be going through our latest report on asset retirement obligations. For this afternoon's session, I'll mainly be focusing on the results for Canada and the UK. Earlier today, we had covered some of the results for Australia. In case you missed this, we will be sharing a recording of the morning session and also the afternoon session in the next couple of days. So what are asset retirement obligations and why are they so relevant? So asset retirement obligations are obligations that companies have to safely decommission their assets at the end of their productive lives. Often costs to decommission or retire these assets may occur years into the future, but companies are required to estimate them and record them as liabilities on their balance sheet. This information is information that they already know when they commission their assets as it's part of their investment appraisal process. And for oil and gas companies, these can be very significant amounts. As you can see there on the table to the right of the slide, they can be quite sizable relative to shareholder equity or even many times over shareholder equity. And these are the company's own reported figures, and this is before we even start to talk about or engage in discussions about what potentially might be off balance sheet. Additionally, assumptions and estimates that go into calculating ARO liabilities could be impacted by economic events like changes in inflation or changes in environmental regulations. And also, as some of our previous work has pointed out, the pace of the energy transition is also a massive uncertainty, which could impact the size of this liability. Next, please. Oh. So to reiterate, the financial statements do not just capture historical information, but also include forecasts that include the management's assumptions of the future. And those forecasts should include considerations of various factors, such as, let's say, the pace of the energy transition, as I mentioned. And if not, these liabilities may be understated, which could affect things such as management remuneration, investor modeling, as well as the company's ability to continue operating in the future. And so transparency of the judgments and estimates underlying or underpinning recorded asset retirement obligations is very important. To add to this, existing accounting standards, such as those under the International Financial Regulatory Standards, already require reporting standards, sorry, already require this. And so some of these requirements have recently been reinforced by the ISB's illustrative examples on reporting uncertainties. And so companies should already be providing these disclosures today. However, we saw something quite different. Next, please. With this in mind, we developed an ARO Transparency Scorecard with the intention of assessing the transparency or the quality of ARO disclosures of a selection of oil and gas companies. These are some of the world's largest oil and gas companies, and in light of the guidance I mentioned in the previous slide, we focus on companies that prepare their financial statements in accordance with the IFRS standards in Australia, Canada, and the UK. We hope that our analysis would help identify gaps in information that is material to investors and also society at large. We also had an objective to see why there might be differences in disclosures, even when you assume that companies apply the same accounting standards. Another objective we had was to create a tool and a set of results that investors can then use in their engagement. Next slide, please. So in a snapshot, the image on the right is the transparency scorecard. As you can see, is grouped into 4 distinct sections that total up to total score of 15. So the first section is a disaggregation section. So we start by disaggregation by non-current or current, i.e. what might be due within the year and what's beyond this. And then disaggregation by activity or by segment. So what portion of the AROs is related to, let's say, upstream versus downstream, if it's an integrated company. And the next one we also looked at is at whether there was sufficient disaggregation of revisions to the ARO liability. Next, we assess the disclosure of key assumptions and estimates, such as inflation rate, discount rates, and estimated cost to settle the AROs. And then we look to see whether or not the companies provided sensitivities related to these assumptions and estimates. And lastly, for some companies where either we had observed or they had stated outright that they may have some unrecorded asset retired obligations, we look to see whether or not there was a description of what was off balance sheet, and we also look to see whether they provided estimated costs to settle these unrecorded AROs. As I mentioned earlier, this scorecard is reflective of IFRS requirements as applied in each jurisdiction. As such, this is really representative of the minimum level of information we would expect for oil and gas companies. And now to the results. Next, please. Oh, wonderful. Thank you. So overall, we found that the quality of ARO disclosures was poor. And it really did vary depending on the company's reporting jurisdiction. I'll cover the results in a little bit more detail per jurisdiction in the following slides, but as you can see, oil and gas companies in Australia that we assessed provided the least amount of relevant information required, with Canada coming in second and then the UK coming in first. In terms of which company provided the most detail, that was BP, which provided roughly 73% of the information required under existing requirements. And the lowest scoring was a 4-way tie between 4 Australian companies who only provided 8% of the information sought. And so overall, investors continue to lack transparency on ARO disclosures. Next. So I'll just touch upon a couple of these key findings before moving on to the results by jurisdiction. One of the main ones was that despite the poor results, the ARO information sought by each metric was provided by at least one company. This shows that the information we are looking for is realistic and reasonable, and that companies can provide it today. In the appendix of the report, we have some examples of company ARO disclosures that meet each metric, which is worth a look. When writing this report, we first collected all the data, then scored the companies. We then looked for potential relationships between scores and individual companies that may further explain these results. This included whether it made a difference about how large the company was or the significance of the ARO liabilities as a percentage of shareholder equity and of market cap. We also looked at whether companies were more likely to provide better ARO disclosures depending on, the timing of the AROs or the ARO maturity or what audit firm audited the financial statements. Throughout, we didn't find any apparent relationships between disclosure quality and the individual company characteristics I just mentioned. The strongest and most apparent potential correlation was between observable regulatory activity by jurisdiction and the quality of ARO disclosures, which leads me next to the jurisdiction slides. Next, please. So, as I said, I'll only be covering Canada and the UK for this afternoon's session. So I'll just cover a few of the highlights of Canada before speaking a little bit about the regulatory activity. So as indicated in the prior slide and this one, Canadian companies performed better than their peers in Australia and the UK when it came to the disclosure of relevant assumptions and estimates underlying the ARO liability on the balance sheet. For example, unlike the other jurisdictions, over half of Canadian companies disclose estimated costs to settle their AROs at the balance sheet date. So this is before they apply any discounting or inflation rates, or even any timing to decommissioning costs, which is important to understand the significance of these costs if they were to fall due today. We also saw that all Canadian companies disclose discount rate information. Additionally, we're able to see that discount rates used by Canadian companies to measure their ARO liabilities significantly differed. For companies we assessed, the discount rates range from 3.3% all the way to 10%. And this is important because different rates can materially impact the size of the balance sheet liability, especially given the size of estimated cost to decommission. So for example, one example I'll use, and I'll then move on to regulatory activity, is Advantage and Athabasca had similar ARO liability amounts on their balance sheet at year end, with similar end dates. However, digging into this, we saw that they used different discount rates to measure these liabilities. Advantage used a discount rate of 3.3%, which was based on Canadian Treasury bond yields, and Athabasca used its own credit-adjusted rates between 7 and 8%. This means that the estimated cost to settle the AROs of the two companies, even though on the balance sheet the liability balances might look similar, are likely very different. So without this underlying transparencies, investors may assume that they are exposed to the same amount of risks when they might not be. In Canada, financial markets are principally regulated by province, and for all of the 19 companies, their primary financial regulator is the Alberta Securities Commission, or the ASC. So in our review of the ASC's observable regulatory activities, we identified some examples of the regulator's work on reviewing and improving financial statements, disclosures, and AROs. However, one thing we did note was that a lot of this work or activity was not recent. For example, in their 2012 continuous disclosure review, the ASC discussed weaknesses surrounding disclosures for ARO liabilities. Using an example of an unnamed company, they stressed the importance of discount rate disclosures, which matches with our findings. They also spoke on the importance of disaggregating revisions to the ARO liability by changes in estimates, i.e. whether or not there was a change in discount rate versus a change in, let's say, timing or estimated costs. However, when we compare with our assessments, we observe that the Canadian companies often didn't provide enough detail on disaggregation by revisions. Also, in the continuous disclosure review, the ASC mentioned that there was some need for more detail around timing information. This also corresponded or correlated with some of that work, where we were able to find out that most Canadian companies did not provide detailed payment schedules for setting their AROs. Overall, based on our review of the ASC's activity, we noted that the regulatory activity well, at least the regulator may need to revisit the topic of ARO disclosures, especially on areas like revision, timing, and also sensitivities, and potentially also off-balance sheet AROs. Next slide, please. So the UK, of the 38 oil and gas companies assessed, the UK oil and gas companies performed better than their peers in Australia and Canada. It was the only jurisdiction overall, it was the only jurisdiction to at least partially meet the 15 metrics. So relative to companies in Australia and Canada, UK companies did particularly well when it came to providing sensitivities to relevant assumptions and estimates, especially sensitivities related to discount rates. The benefit to this is that you're better able to assess the impact on the ARO liability if discount rate assumptions were to change. And for most of the UK companies, the discount rates they used were based on treasury bond yields. So, say yields were to rise or fall, an investor is now able to identify how much that ARO liability might change by, which is a very useful information to know. Also, a few of the UK companies indicated that they had off-balance sheet AROs. Of these companies, most provided a description of what was unrecorded and could be related to, such as refining assets that are indefinite lived. However, only Parkmead had details on the estimated costs to settle some of its unrecorded AROs. In terms of metrics that the UK struggled with, we found that the UK companies typically tend to struggle in providing a full payment schedule or timing for setting their AROs. Often we would not see any information about timing, or if there was, it was usually incomplete and not granular enough. For example, some companies would break out their timing of their AROs in 5 or even 10-year chunks. Then beyond, let's say, the 11-year mark, there would be no further detail on the timing of cash outflows to decommission their assets. These remaining amounts would often be quite sizable portions of their total ARO balance, meaning that investors have limited visibility on the cash outflows of a company. In the UK, the Financial Reporting Council is responsible for regulating financial reporting. And in our review of regulatory activity, we noted that the FRC conducted a thematic review on the application of IAS 37, which is the IFRS standard that governs the accounting for ARO liabilities. In it, they indicated that what good disclosure looked like. Oh, sorry. In the context of AROs. So, for example, they discussed the importance of disclosures on discount rates and also sensitivities. This seems to match up with what we saw in our assessment of UK companies. However, there were a couple of other examples of good disclosure that the FSC had given that did not seem to correlate with our assessments. For example, the FSC had stressed the importance of good disclosures on expected timing of outflows to settle ARO costs. However, as I mentioned earlier, UK company disclosures were often poor in this area. So more focus on these areas by the FRC could help to improve ARO transparency. And now I'll move on to some of the key action points. The next slide, please. Yeah. Oh, if you go back one. Perfect. So key action points that we had for oil and gas companies were mainly that these companies should disclose underlying assumptions and estimates used to determine the ARO liability on the balance sheet. It would also be beneficial for the oil and gas companies to provide more detail around the reasons behind revisions and they make to the ARO liability balance. And also for those ARO liabilities related to multiple segments or different activities, it'll be useful if they disaggregated them accordingly. Next one. If you go on back one more. Yeah, there we go. And for investors, we would really encourage you to use the report to understand the importance of AROs. Also, as I said at the beginning, we hope that you can use the results of the report and the scorecard as a tool to inform some of your engagement activities in seeking for better transparency in financial statements. Again, just to reiterate that the information sought by the scorecard is grounded in existing IFRS standards, and companies should already be providing them. And this information is objective, and management already has it or has this information. And then the next one. Oh, back one more. There we go. So for regulators, our general recommendation is to focus on the quality and transparency of disclosures on AROs, obviously, but especially in light of the ISB's recent guidance and also the result of our report. Per jurisdiction, we think that the ASC should revisit the topic of ARO disclosures with a focus on sensitivities as well as off-balance sheet AROs and revisions. And for the FRC, we think that they should dig deeper into areas such as revisions, timing, which we identified were incomplete in UK company ARO disclosures. And with that, I shall hand it over to Barbara Davison, who will moderate the panel for this afternoon's webinar.
Thank you so much, Tino. That was really covered quite a lot of information, and really appreciate that really comprehensive overview. And we just need to turn on one camera, I think, on that. There we go. Great. Excellent. Thank you. So I've been asked to remind the audience before I start to please submit Q&A questions for us, or I'll just make sure the panel goes indefinitely, like like the assets. Hello to everyone. Thank you for joining us today. Rob, it's great to see you here as a CT Carbon Tracker alumnus, and Phil, it's really good to have you as the investor rep. So thank you both for joining. Really appreciate this. I'm going to start with Rob and Phil I'd like you to give the audience a brief overview of why the work that you're doing today is relevant to ARO disclosures. And I'm going to ask Rob to start to answer that, please.
Sure, Barbara. Thanks, and thanks to Carbon Tracker and everybody at the team. It's great to be back with you today. We at the Polluter Pays Project are doing quite a bit of work looking at asset retirement obligations globally, and in particular the accounting. And I think one thing that's really important in terms of this work is to think about an example that happened a couple of years ago, and it was the bankruptcy of Fieldwood Energy, a large operator in the Gulf of Mexico, a mature field operator that had acquired assets from Apache and from Chevron and a bunch of other companies. Well, it went bankrupt for the second and final time, and as part of that process, a lot of interesting things came out that make it really relevant from an accounting perspective. So the first was it was a huge ticket for the liability. And because the Gulf of Mexico has trailing liability, that meant that over $1 billion to Apache and then to Chevron in terms of expenses that were not on the balance sheet before because they were viewed as too remote to even be noted as contingent liabilities, all of a sudden appeared. That's really significant. But the other thing is when you saw in the bankruptcy, you could see that the companies knew about this and had tried to protect themselves in some way. So, for example, Apache had required that Field would spend $80 million a year on remediation and reclamation and fund a trust that was restricted cash up to 125% of the value of the liabilities. That's particularly significant because most jurisdictions and most regulators don't do that today. But if that can be imposed by one party on another in a private market transaction, that means it's quite possible that regulators could be asking for the same sort of help. And what we see in jurisdictions as basins decline is that regulators become more serious about this. This is happening in California. It's happened in Colorado. And so, whatever your thoughts are on the energy transition, basin decline can be a major driver of regulatory action that gets these costs to come forward, even if the economic life of the assets hasn't changed.
Thank you, Rob. That's really, really good information, important information to have, and hopefully maybe regulators will also think about this for other types of assets, right? Like downstream assets, but I'll put that to one side. Phil, please, if you could also respond to that question.
Sure. So I work for BNP Paribas Group. As a group, we have been looking at decommissioning or AROs for a number of years now and trying to develop solutions for corporates and for institutional investors that are looking at the theme and concerned about the theme. So to give some examples there, we've worked with oil and gas companies to create decommissioning reserve funds. One thing you notice when you look at the report and accounts is very few of these oil and gas companies pre-fund these liabilities. They pay them out of cash flow, which means, like a lot of mining companies, they're very heavily correlated to the oil price, obviously. So when the oil price is doing well, you can just kick the can down the road. But when the oil price is doing less well, and of course that's precisely when you're probably going to have to pay for the assets to be decommissioned, is when the oil price is collapsing. So we've been trying to encourage corporates to pre-fund those liabilities, and basically it's a pension fund. It's creating a pot of money that will meet liabilities in the future. You use market returns, and put simply, it's a more efficient way of lowering the cost to the corporate and making the contributions. So decommissioning reserves, we've been creating transition funds, helping oil and gas companies transition, invest in new technologies. Many of these companies, less so the larger ones, but the smaller companies, perhaps lack, they're an oil and gas company. They explore for oil and gas. They don't know what the new technologies are, or what the winners will be within carbon capture, carbon storage. So they're looking to us to build them a diversified portfolio of new technologies, which will enable them to pivot their business model. And the bank has also been looking at issuing sustainability-linked bonds, decommissioning bonds, in order to help them, as CFOs become more constrained about where they can get capital, as banks start to pull back from lending to E&P, institutional investors start pulling back. So we're offering solutions through capital markets, looking at decommissioning bonds, for example. So probably the final thing to say, all of that wrapped together means that we've been looking at decommissioning now for a number of years. And not to depress everybody too much, but we did a study a number of years ago where we identified $8 trillion globally of assets that needed to be decommissioned. And why it's pertinent to today is $1 trillion of that was oil and gas. Now, what we know since that time period is that subsequent revisions and subsequent papers that have come out have revised that number up by a factor of 200, 300%. And we'll delve in a moment to why that is. So what we know is that they are consistently understating these liabilities, and every time a new report comes out, the report comes out with a higher and a higher number. So whether you're investing in the equity or the debt of these businesses, you need to know these numbers, because it will impact the business model, it will impact the returns on your equity, impact whether the business is solvent, and it will certainly impact whether or not, as a fixed income holder, the company is even, possibly going to pay your debt back. So it's a critical area that you're looking at, and we'll delve into more detail as to what the issues are.
Thank you. That's really, there's a lot of big numbers that we're talking about, which I think is already hopefully coming clear to the audience why this transparency is so important. And going off the back of the discussions that Tino had about the scorecard assessments, I want to follow up a little bit more, if you could, with you, Phil, before I go back to Rob, to expand on why this information, more than you were already saying, is important and material to investors.
Yeah, so if we bring it back to oil and gas and we look at the North Sea, the liabilities are somewhere between 40 and 50 billion, if you're to believe that number, and I would put it to you shouldn't. We already know in the North Sea that cost overruns on average are 76%. So you can take, let's call it 50 billion, and multiply it by 176%, because that's going to be more like an accurate assessment. And then as we come on to look at the accounts in a moment, there are very serious issues with are they taking into account off balance sheet liabilities? Do they take into account where they've got minority stakes in JV fields, for example, in the North Sea? Many of them don't. Certainly, we see that within the mining sector as well, that those numbers are not necessarily included. And so when you start to go through these, you really can multiply these numbers by a factor of 2 or 3. Now, what we've seen, we've done many studies on different sectors, oil and gas, mining sector. You see an increase in the absolute amount that is paid each year to decommission. And oil and gas companies will point to this and say, well, look, we're spending more and more and more money on decommissioning. But what you also see is that the liabilities are increasing at a faster rate than the money that's being put into. So, I mean, I hasten to bring this back to the mining sector, but I mean, some industry participants have likened the mining sector to a Ponzi scheme. I mean, and these are people that work within the industry. They recognize that that's how the industry operates in which they work. So if you're making comments like that, in all seriousness, I don't think we're being given the right numbers. I mean, again, I could go into more detail as to why these numbers are inaccurate. But I mean, Tino's hit on most of them. I mean, off-balance sheet liabilities, wage inflation, regulatory changes, the fact that they're reported on a P50 rather than a P95 basis, which is how we work in the investment industry, all of the DCF, the timing of the DCF. I mean, obviously, you want to discount these things at the highest rate possible and kick the can as far down the road as possible, so the liabilities are as small as possible in important accounts. And the thing is, there's no consistency in the way that oil and gas companies approach this. And so as an investor, it's almost impossible to make an accurate assessment and almost impossible to make a comparison between company A and company B. And if you're stock picking or if you're bond picking, that's not a pleasant situation to be in. So I think all of these issues that we're discussing today are absolutely relevant for investors and market participants alike.
That's great. Thank you. There's a lot to unpack there, which we won't unfortunately be able to do today, but this is really important to hear. And I'm going to skip over Tino, sorry, Tino, and go straight to Rob on this, because I think that, I think that Tino and Phil addressed a lot of what Tino had already said. But Rob, we go to Rob and kind of talk about, we know in the past you've done a lot of work on AROs in the United States while you're here at Carbon Tracker, and I think it would be really important to again hear your views on the materiality of AROs based on your experience then and even now what you're doing today.
Yeah, thank you. So yeah, I mean, I think for all the reasons that Philip mentioned, we're in a situation where the data is unfortunately not fully reflecting the size or magnitude of the problem and the reality that the problem is actually growing and will grow significantly. So is it material? It's material, I think, by a lot of measures. You pointed out, for example, looking at some of these smaller companies that have shareholder equity issues, where the shareholder equity is sort of a smaller fraction than the outstanding ARO liability. That's not true for the companies at the top, but that's true for lots of companies that have acquired assets from the companies at the top. And when you're in a jurisdiction where there is trailing liability, you have the potential for defaults at the bottom of the food chain to work their way back up. So that would be the case, for example, in the UK North Sea, right, where you could imagine something like that transpiring. And as an interesting anecdote, I mentioned Apache earlier, which is now APA Corporation. They made a decision, potentially after having, looked at what the market, who the potential buyers would be, I'm not sure. But they've made a decision that they're going to accelerate the decommissioning of their assets and do that work themselves, rather than the kind of sale exit that transpired in the Gulf of Mexico. Don't know why exactly that's the case, but it could be part of their experience that they had with Fieldwood. They say, okay, we're going to have to eat these costs. And I think as companies start to really sort of think about that, that's going to impact all kinds of other investment behavior, including, for example, if you're thinking about shale in the US, the valuation of legacy assets in acquiring them.
Sorry, my unmute is not working. Thank you so much, Rob. That's thank you. I think maybe we should then kind of go based on you were saying the data is not reflecting the size of the problem. Go to Tino to talk a little bit about why the recent accounting guidance that came from the International Accounting Standards Board is so important. And maybe you could touch on what we would hope to see from companies going forward as a result.
Yeah, sure. So the recent guidance or the illustrative examples on reporting uncertainties is very important because it really reinforces existing IFRS standards, especially on these areas that are subject to such I guess subject to such uncertainty and can change depending on the economic or the regulatory environment as well. And in terms of what we would reasonably be expecting from companies going forward, so the ISB published them in November 2025, and they had published some draft examples back in October earlier in the year. So we would hope to see, better transparency, not just on AROs, but on other elements such as on impairment and also disclosures around remaining useful lives from the financial year in 2025 accounts, especially for those with the, let's say, June year end, who have had more time to really incorporate this into their financial preparation.
Thank you, Tino. And I was going to stay with you for a minute, but I thought I'd also just remind the audience, because I see a couple of questions on this already, that we right now are looking at the IFRS companies because the work that we did is driven by the ISB's guidance, which is IFRS reporters. Doesn't mean that this doesn't apply to US reporters. So no, we didn't look at US companies yet, but this information is still relevant and should be disclosed by US companies. I had to say that now while you're listening, or while we're in the middle of the panel. So Tino, if you can really briefly remind the audience why it's so important that also we're seeing disclosures vary by jurisdiction and they are all IFRS reporters.
Yeah, so that's the key thing. They're all IFRS reporters. They all should be applying the same standards in similar ways, and so information should be able to be easily comparable, depending on whether or not it's a company in Australia or Canada or even the UK. So, however, this is not necessarily what we saw. We saw variations across those jurisdictions. We even saw variations within the same jurisdiction, which obviously makes it hard, as Phil already indicated, makes it hard for anyone who's trying to appraise, the investment worthiness of any of those oil and gas companies.
Thanks, Tino. I mean, it is, Phil had mentioned that comparison is nearly impossible, which is really, I find that struck me because these are the same requirements. And I think more or less these companies are going to be exposed to the same risks other than perhaps upstream, midstream, and downstream issues. But Phil, if we move to you about those risks that we're talking about and about the risk of non-disclosure and the risk of what do you see as the risk to someone not adequately understanding and also managing the decommission of these assets? And I think you already mentioned this, but do you think that estimated decommission costs are adequately covered today? Or we could say it again.
Released relatively recently by, I don't know if you've seen it, from Investors for Paris.
Yes.
From Canada.
Yes.
Precisely on this issue, looking at the variability of DCF and the impact that it has on these long-term liabilities and the way in which the companies are using that to lower the liabilities. And yeah, I mean, we see it as one of the key findings of our study on the oil and gas sector is the variability of DCF rates that are being applied. which makes comparison, unless you're a financial analyst, makes the comparisons quite, time consuming, if not impossible. There's also a question in the feed. Sorry, I've got one eye on the questions in the feed as well. So when I talked to the decommissioning number for the North Sea and why it was too low, one of the first question in the feed is whether or not that number includes downstream, and of course it doesn't. So the number for decommissioning in the North Sea doesn't account for all the downstream assets. It really only looks at large infrastructure. So yeah, I mean, when you add in the pipelines, the refineries, everything else that needs to be decommissioned. Now, an interesting feature of this, which we're starting to see an ecosystem coalesce around some of these assets, because there are players emerging that will buy them, repurpose them, redevelop them, and either manage them themselves as equity owner or sell them on. So there is an emerging investor base that are looking at these sorts of environmental liabilities and whether they can be redeveloped and repurposed. I mean, for anyone that's sitting in London, you've seen Battersea Power Station, you've seen Tate Modern, you know it's possible. It's not possible with every asset. And actually that also comes back to the only portion of this where I have some sympathy. And it's maybe less acute in the oil and gas sector, but if we think about the role of auditors here, I mean, and I've seen disclaimers on report and accounts that say there are additional liabilities, but we can't value them, but we know they're there. But just to say, here's a disclaimer, there are other values that we haven't included in these set report and accounts, and they sign it off. Now, the only sympathy I would have is that these assets are kind of idiosyncratic, particularly if you look at other sectors like mining. No two mines are the same. No two remediation plans are the same. So you can't realistically ask them to value these assets. But I think a good starting point would be to have some common standards, at the very least, in how you approach and put your report and accounts together when it comes to these liabilities, which we're not seeing today. So I don't know if that answers the question or a couple of the questions in the feed, but it feels a little bit like the Wild West, and it feels a little bit like unless companies are compelled to some form of standardization, that it will remain the case.
Thank you. I think I would, and I was just going to make a couple comments and then move to Rob. I mean, the comment you made about refining assets possibly, or downstream not having liabilities on the balance sheet, that's what we're talking about. We're talking about off balance sheet. And our understanding actually, and we can get into this in another discussion, is that when companies enter into the agreement or the decision to invest or make the final investment decision in these assets or commission them, they understand, they do have an idea of the cost. So that's another discussion, or actually we could bring Rob in on that if you wanted to talk about that. But that was one of our understandings and arguments. And so if we move on to Rob and asking Rob, what do you see as the risks of understated ARO disclosures? And also, as part of your answer, could you also talk about the importance of the population selected, about the smaller oil and gas companies that are in this population?
Yeah, so, well, look, I think the risk of understatement is underappreciation of the problem. I think that's pretty much always the case. And with respect to refineries and things like that, I think, one of the things that, that happened with this, they're very similar standards under US GAAP and IFRS in this regard, on this topic. And one of the things that happened in US GAAP was, I think in some ways, a bit of sophistry that lost the point of forcing this information to come out. And so, essentially there was an argument made primarily by industry that, hey, for some assets, we don't know how long they're going to live. And that's a fair point. We don't know how long there are refineries that have been around 100 years, okay, and may continue to operate for some indefinite period. And since we don't know, we can't schedule when it's going to close. And since we can't do that, we don't know from what point we should discount to the present value. So we shouldn't put anything in. Well, you could have put in sort of, what generic expectations. You could have put in a cost that says, look, this is not the discounted costs are not comparable in that sense, but this is what we think it will be. But we now have a system instead where literally we will have, and you saw this in California in the last year, companies say, this asset will live forever, and then announce, no, we're going to close in 12 months. Okay, we're going to close this refinery in 12 months because we have to wait 12 months before we close a refinery. Okay. Well, you don't want a situation where a number is not disclosed at all because of uncertainty that becomes absolutely crystal clear 12 months before costs are going to begin to be incurred in terms of scoping and managing what's going to happen with that asset. So I think there certainly is an issue there. In terms of the universe of the companies selected, I think it's important to know that this issue will impact companies differently across the value chain. So you have, mature operators that have comparatively lower production volumes, let's say coming out of some of their aged assets. They are closer to retirement. They're closer to that moment when, right, future cash flows, whatever they're going to be, may be exceeded by the future liabilities that are coming closer due every day. So, they have a different situation than you have some of the larger operators that may have capacity to readily handle all of their current asset retirement obligations, but also have to worry about all of the legacy fields, right? So you have these folks who've, focus on exploration, working with assets early in their lives before they then sell them on to the mature operators. They have a very different situation, and understanding how those liabilities might boomerang back is a significant factor to consider. And so that's why it's good to look at really all of these companies, that sit throughout the value chain. I think you're on mute, Barbara.
Sorry. Yeah, from, Rob's describing almost like a cliff drop off that we've seen with some refiners where they say exactly what Rob said. They don't give any disclosure and all of a sudden they start recording AROs. Tino had talked about in his presentation what regulators can be doing in different jurisdictions to ensure that investors and other stakeholders are getting the information that they need. Rob, if I stay with you for a minute, what steps from your point of view should policymakers and or financial regulators be taken?
Well, I think the policymakers are going to come to, and I mean the oil field policymakers, but it impacts the financial regulators, so I'll mention it quickly. I think that they're going to come to the point that they're going to say what we really need is cash in hand, both to pre-funding essentially of some sort, whether it's cash or other things, or a sinking fund that gets built in. They're going to come to that conclusion because it's not just to have the money available, it's to incentivize the operators to do the work and to get to a point where they say, okay, we're not going to just delay and defer, because otherwise it is frankly in the economic interest of the operator to delay and defer these as long as possible, including past the point at which there's capacity to pay to settle. So to the extent that happens, you would see financial repercussions, for example, having to put restricted cash on the balance sheet if that's what has happened, or other things. So you're gonna see that kind of impact. And I think you'd see as there's greater interest from regulators, greater concern about whether the costs are accurately reflected. One thing people don't really know is that a lot of oil field regulators have and are increasingly looking at what are the actual expected costs of decommissioning. That may include making information calls, getting better data from actual commercial activity on decommissioning to understand it. And to the extent those numbers become clearer, it offers a comparison to what companies are reporting, right? Are they reporting numbers similar size and magnitude, or are they doing something different? So I think as that happens, we might see some changes also there. In terms of what financial regulators should do, I think the key point, and I think one of the things I like a lot about this report, is that a lot of this is a sort of finite set of variables and assumptions and estimates that need to be considered, and they're all considered in this report. Really, what regulators could do is look to how do we have more transparency about what these assumptions are. I think normatively the goal should be to provide enough information about the assumptions that the companies have made that analysts could make adjustments if they deem that prudent in order to understand, and can also normalize numbers across companies so they can understand, okay, well, $1 billion for this company is different than $1 billion for this company because the discount rates are drastically different or whatnot. Standardization and things like, for example, PV10, which you see in the US on oil and gas, where assumptions are standardized in order to have an apples to apples comparison, is not totally foreign to disclosure requirements.
Okay, I got my unmute to work. Yeah, thank you, Rob. I mean, we're seeing some of that standardization in the Canadian accounts as well. And the other thing that's important to remember here is the assumptions and estimates that we're looking for in these disclosures is information that these oil and gas companies do have, especially for the liabilities that are reported. They already have them in their internal control systems. They already have the numbers there. They wouldn't be able to record the liability. So that information is available to them already. Phil, if I go to you now, kind of following again on this the market after question, and based on your experience, what policy or regulatory actions do you think are needed, and what advice would you give to investors? And then I'm going to go to Q&A.
Yeah. To the Oil and Gas Authority in the UK, now the North Sea Transition Authority, as was the Oil and Gas Authority, about this issue of pre-funding these liabilities, compelling companies to put some money aside, whilst the oil price is high, etc. As far as they're concerned, the horse is bolted on that. They say, we should have done it. Hands up. We didn't do it. One could say that the entire country should have taken the proceeds, a little bit like Norway, and created a sovereign wealth fund out of it. But I mean, that's a different matter. So the issue of this pre-funding issue, so where the oil NSTA rely on those liabilities being passed back from companies to smaller companies, if they go bust or they're insolvent or their inability to meet those liabilities, will go back to the previous owner. And so you make your way back to the oil and gas majors in each case. Now, that's not really been tested yet. It would be interesting to see what happens to the balance sheet of those companies if they absorb all the liabilities from all of the small players that are underneath them. I just don't think it's a realistic solution. So I think we need to re-examine this and think about it in a different way. Now, again, in the Q&A, there's questions around the hundreds of thousands of people that currently work in the oil and gas industry, and the fact that we need to see a just transition and so on. And I absolutely agree. But I could envisage a role for decommissioning and transition bonds that are issued almost as, if you think about a muni bond in the US, for example, you could issue regional bonds that are used to redevelop some of the assets that are there. Some of the assets that are there can be reused and redeveloped. Some of the engineering skills that are there can be reused and redeveloped for renewables, create green hubs. And there are selective case studies of that going on, which is good. But there's no coherent policy or indeed pipeline for institutional investors to point to and say, yes, I'll invest in this one, yes, I'll invest in that one. So it's all a bit fragmented. There's no real top-down policy on this. But of course, we all want to see a just transition. The reality is we're going to still burn oil and gas for the next X amount of time. What we're trying to do is decelerate the need for them and accelerate the energy transition at the same time. So I think it's a tricky one. There's definitely a lot. It's a complex issue. There's more, and it becomes even more complex when you look. I mean, the North Sea ought to be the poster child for decommissioning, because I mean, it's a mature oil field, unless you believe Donald Trump, of course, and you think there's another 500 years to me. But it ought to be the poster child for decommissioning, but it isn't quite there yet. There's some good initiatives going on. And again, just to come back to the AROs and the disclosures, yes, there are some actors out there that are doing better than others. There are some that are disclosing, and there are some that I would say have some form of moral compass. But there are definitely some out there that I say have no form of moral compass and are misleading investors. So to finish up, what would I would urge investors to seek better disclosure. I would urge accounting standards to apply some common principles and some common standards, which in theory exist but don't seem to be really being applied. And I think we need from government, again, better pipeline of infrastructure and redevelopment projects coming through that people can redevelop some of these assets. It's not just about, knocking them to the ground and moving on. Some of these can actually represent assets into the future. But you're going to need, particularly to compel oil and gas companies to do that. There's going to need to be some form of compulsion, or there's going to need to be some form of incentivization for them to clean up, because history suggests and the data suggests that the liabilities are increasing, even though the decommissioning spend is increasing. Don't get me wrong, it's increasing from a very modest level, but it is increasing. So there's lots that people could do to, it doesn't even need a revolution in the system really, just to tweak the system to, just shift the focus and move us into a, perhaps a more positive environment. And as I say, we don't want to get to a situation where, I wouldn't want to see a situation as we're seeing other jurisdictions in Canada and elsewhere, where you're getting rising litigation from environmental groups because they see no other way. They don't want the taxpayer to have to pay for this. On, the polluter pays principle would suggest that the companies that have derived profit from these assets should be compelled and forced to at least pay for some, if not all, of the cleanup, rather than walking away. And so, the situation, dare I say, in conclusion, for other sectors like mining are even worse. I mean, if you look in Australia, there's 50,000 abandoned mines. Let's just think about that number. 50,000 abandoned mines in Australia. If you get to the situation where the 8 trillion of decommissioning assets, which are understated, as where we started, if those 8 trillion are passed on to the taxpayer because everyone else has just walked away, I suggest we've got a problem, and that the energy transition is going to be it's a long wait coming.
Thank you. And I know I'm not supposed to keep asking questions, but because Simon's back on, but thank you, Phil. I'm going to ask Rob to respond to one question in the chat, because I think it follows on from what Phil is saying, and then we're going to have to wrap it up. Rob, there's a question about how prepared are governments for taking on liabilities that are not covered, and what policies are needed. And you talked about that briefly, and Phil talked about that over here, but did you want to add anything to that before we wind up?
I would say for the most part, they're not prepared to take these on. These are going to be new costs that are going to require new budget expenditures. But there are also even more fundamental things. I mean, California is finding out that they don't really have any solid laws governing the process for decommissioning refineries. And that would, the best time to do that would be decades ago. So there are certainly issues there, all the way down to sort of engineering specification. Over the years, we've seen in the US, some states get better about this, but overall, the state is one of unpreparedness.
Thank you. There's so much here that we could cover and we haven't, which is a hint to try to bring these guys back. We have a lot of questions in the chat we did not answer, and I think we're going to try to respond to them separately. Thank you again so much, Tino, Rob, and Phil, and the audience for everything. And I'm going to pass back to Simon.
Great, thanks, Barbara. That was fantastic. And I think this morning we had a pension analogy, which I thought worked very well. These are effectively underfunded pension schemes for assets. And we've got underfunded pension schemes now on the balance sheet of companies, and so why shouldn't these be any different? And that was a great analogy for from the morning session. Again, to echo, thank you for your time. A copy of the slides and recording will be sent to you in the next couple of days. And if you have any follow-up questions, just please get in touch. Thanks to our speakers, Philip, Rob, and Tino. Marvelous set of moderating by Barbara. And of course the behind the scenes team led by Marina. Next up from us is the launch this week of our report in association with Exeter University, Recalibrating Climate Risk, and is a roadmap to fixing climate scenario analysis by closing the science/economic gap. And if you're interested in investment risk of agricultural methane, check out our sister company Planet Tracker's new report launched yesterday. Both are available on our respective websites. But until then, thank you for your time and have a great rest of the day. Bye-bye for now.